Last Tuesday, something quietly shook the bond markets, barely making headlines, but anyone paying attention should have been alarmed. UK borrowing costs jumped to levels not seen since 2008. The yield on 10-year bonds hit 5.2%. That might sound abstract if you're not following markets, but here's the reality. It translates to roughly £50 billion extra in annual interest payments on existing debt. £50 billion just gone, vanished into higher costs. And even if you don't own a single bond, this matters. Financial crises don't send out polite warnings. One day, everything seems stable. The next, markets are tumbling, savings are at risk, and the economy is in chaos. Right now, the UK is sitting on all the conditions that can spark that kind of panic. Stick with me. By the end of this video, you'll see what triggers market panic, how close the UK is to breaking points today, and most importantly, the warning signs that tell you it's time to act before everyone else catches on. Because if you wait until the crisis is obvious, it's already too late to protect yourself. Let's unpack how financial crises really unfold. Most people imagine wild crashes, stock markets plummeting, banks collapsing, streets in chaos. That's the dramatic finish, but it's not where it starts. The beginning is often slow, technical, and invisible, until suddenly it's catastrophic. At its core, a financial crisis is about confidence. It's the moment that confidence snaps, and everyone tries to exit at once. Think about a bank run. Your bank is probably fine. It manages your money responsibly. But if everyone suddenly fears the bank will fail and rushes to withdraw at the same time, the bank fails not because it was insolvent, but because fear made it collapse. Because banks only keep a small fraction of deposits in cash, no bank can handle everyone demanding their money at once. Panic creates the crisis. Financial markets operate the same way. Countries can carry massive debt for decades without collapsing. Japan's debt is over 200% of GDP. The US is over 120%. They're not in crisis. Why? Because markets trust they can pay it back. Confidence matters. But when confidence falters, when investors start doubting debt is manageable, things spiral fast. Here's how it usually unfolds. Something spooks investors: a weak economic report, political turmoil, or problems elsewhere. The trigger itself hardly matters. Investors start selling bonds. Falling bond prices push yields up automatically. That's mechanical. Higher yields mean more expensive borrowing. More expensive borrowing worsens the debt picture, making investors even more nervous. They sell more, yields climb higher, costs rise further. This feedback loop is the doom spiral, and once it begins, stopping it requires massive intervention or radical policy shifts. The UK saw this clearly in September 2022 with the Liz Truss mini-budget. Unfunded tax cuts were announced. Bond markets panicked within hours. Yields spiked, the pound crashed, pension funds teetered on the edge. The Bank of England had to step in with emergency action. Within 6 weeks, the Prime Minister was gone, and the policies were reversed. That wasn't a distant theory yet. It was a real crisis under 3 years ago. Only bold policy reversals and central bank intervention contained it. Now, here's the worrying part. The underlying fiscal situation that made that panic possible has worsened, not improved. Debt is higher. The deficit remains large. Borrowing costs have risen. Growth is weak. The spark for another panic is already in place. We haven't triggered it yet, but the fuel is ready. Let's break down the numbers. The UK is in what economists call a debt trap. Escaping it is mathematically tough. Total debt sits around £2.7 trillion, roughly 100% of GDP. Every pound the UK earns in a year is matched by a pound of debt. High debt alone isn't catastrophic. It's the trajectory and costs that trap the country. First, the trajectory. The UK runs a deficit of about £100 billion per year. Spending exceeds revenue. That £100 billion is added to the debt pile annually. Debt is growing, not stable. Second, the cost of servicing that debt, paying interest alone, costs roughly £120 billion every year. That's more than the entire defense budget. It's money that doesn't build anything: no hospitals, no roads, no investment. It just disappears. Paid to bondholders. Here's where the trap tightens. The deficit is about £100 billion, but interest costs are £120 billion. In other words, we're borrowing just to pay interest on debt we've already borrowed. That's the textbook debt trap. It gets worse. A huge chunk of UK debt is maturing in the next few years. When bonds mature, they must be refinanced old. Bonds are replaced with new ones. Around £600 billion comes due over the next 3 years. Much of this debt was issued when rates were near zero, sometimes just 1%. Now, refinancing costs 5% or more. That's a 4-point jump on £600 billion, adding roughly £24 billion in annual interest alone, before accounting for new borrowing to cover the deficit. So the UK needs £100 billion for the annual deficit, plus £600 billion to refinance maturing debt, about £200 billion in bonds sold every year. Markets can handle that if they stay confident. But if investors get nervous and demand higher yields, everything spirals. Each 1% rise in yields adds roughly £25 billion.
Major vulnerability, and this one can turn debt trouble into a currency crisis fast. The pound has been weak for years. Since the 2016 Brexit vote, sterling has lost 15 to 20% against major currencies. Some decline matches fundamentals, but part of it reflects falling confidence. A weaker currency isn't always disastrous. It can boost exports, but the UK has a specific problem. It imports far more than it exports, running a persistent current account deficit. That means it constantly depends on foreign capital flowing in to balance the books. Here's where things get dangerous. When the pound weakens, imports cost more: food, energy, manufactured goods. Most of what we consume comes from abroad. Higher import costs push up inflation. Inflation forces interest rates to stay high longer. Higher rates increase debt servicing costs and slow growth. Slower growth makes investors nervous about UK assets. Nervous investors sell sterling. The pound falls further. That's how a debt problem can spiral into a full-blown currency crisis. Once it starts feeding on itself, stopping it is extremely difficult without massive intervention or drastic policy changes. The UK's defenses are limited. Foreign exchange reserves, the money available to support the pound, stand around £140 billion. That sounds big, but in global currency markets, determined selling can overwhelm that in days. The UK also relies heavily on foreign buyers for debt. A large portion of bonds must be sold to international investors. If they lose confidence in the debt or the currency, capital can exit rapidly. That's what happened in 1976. Sterling collapsed, the country couldn't finance its deficits, and the UK had to turn to the IMF for emergency support. The conditions were harsh: massive spending cuts, falling living standards, years of economic pain. That crisis required outside help because the UK couldn't stabilize itself. The same scenario could happen again. The ingredients are all here: weak currency, heavy external financing needs, limited reserves, reliance on foreign confidence. What could trigger it? Many things: weak economic reports, political instability that shakes trust in policy, or contagion from crises elsewhere that makes investors pull back, including from the UK. The Liz Truss episode in 2022 was a small-scale version of this. Markets panicked, and we got a taste of how fast confidence can evaporate. The pound fell to $1.03, almost at parity with the dollar. Bonds plummeted. It took emergency central bank action and a complete policy reversal to stabilize markets. That was a warning, a clear demonstration of how vulnerable the UK is to this kind of panic. And the fundamentals haven't improved since. They've gotten worse. Debt is higher. The deficit is larger. Growth is weaker. Today, we're closer to a sterling crisis than we were during the Truss panic. We just haven't had the trigger that makes everyone try to exit at once. But the risk is growing. Now, consider the institution meant to prevent crisis: the Bank of England. It has two objectives that are increasingly at odds. 1. Control inflation, keeping it around 2%. 2. Maintain financial stability, ensuring markets don't collapse. Here's the problem: achieving these goals now requires opposite policies. Controlling inflation demands high interest rates, slowing the economy, reducing demand, and bringing prices down. But high rates also raise debt costs, stress property markets, hurt growth, and make financial instability more likely. Maintaining stability in a crisis requires cutting rates and buying bonds to calm markets, but that loosens conditions and risks reigniting inflation. The bank is trapped, and they've already shown which goal takes precedence when push comes to shove. During the trust crisis, they chose stability over inflation, buying bonds to prevent pension fund collapse. It was the right move at the time, but it exposed the impossible position they're in. Here's what makes it more worrying. Their tools are limited. Interest rates are already above 4%. They could cut, but not by much before hitting zero again, a limit they've reached before, after the financial crisis and during COVID. Their balance sheet is huge from years of bond buying programs. They're supposed to shrink it, selling bonds to normalize policy. But if another crisis hits, they'd have to start buying again. Repeated emergency bond purchases create a real problem. It starts to look like they're funding deficits with printed money. That undermines currency credibility, destabilizes inflation expectations, and could trigger the very currency crisis they're trying to prevent. The bank might handle one more emergency intervention, but multiple crises and repeated interventions? That's a risk no system can easily absorb. At some point, markets stop believing that authorities can control the situation. At some point, the credibility that makes central banking work simply disappears. And here's the scary part. That moment can arrive suddenly. Central bank credibility is fragile. Once it's gone, it's gone. Regaining it takes years of ultra-tight policy, causing severe economic pain. Look at Turkey. They kept rates too low for too long, despite soaring inflation. Markets lost faith in their central bank. The currency collapsed. Inflation hit 85%. Savings were wiped out. Living standards crashed. The UK isn't Turkey, but the mechanism is the same. Loss of central bank credibility can trigger currency collapse and an inflation spiral. The Bank of England still has credibility, but it's more fragile than most people realize. One badly handled crisis could damage it severely. And with limited tools left, mismanaging a crisis becomes more likely. Now that you understand the vulnerabilities, here are the warning signs that a crisis could be imminent. If you want to protect yourself, you need to spot them before everyone else panics. Warning sign 1. 10-year gilt yield sustained above 5%. Short spikes happen, but weeks above 5% signal serious market concern. Warning sign 2. Weak bond auctions. Bonds are regularly auctioned, and results are public. If auctions fail to attract buyers or require unusually high yields, that's weakening demand. One weak auction is a fluke. Multiple is a pattern. Warning sign 3. Sterling breaking key levels against the dollar. Watch 1:20. Below that is concerning, below 1:15 alarming, below 1:10 panic territory against the euro. Sustained drops show confidence is fading. Warning sign 4. Credit default swap spreads widening. These are insurance premiums against default. If they rise above 200 basis points, markets are pricing in much higher risk. Warning sign 5. Emergency central bank actions. If the Bank of England starts emergency bond purchases or emergency bank funding outside normal operations, it's signaling severe stress. Don't ignore it. Warning sign 6. Accelerating capital outflows. Watch for foreign investors selling UK holdings, companies moving treasury operations, or wealthy individuals shifting money offshore. That's insiders preparing for trouble. Warning sign 7. Derivatives and market stress. Watch the spread between cash bonds and bond futures. When it blows out, it signals extreme funding stress. This preceded the trust crisis. Technical, but reliable. Warning sign 8. Property market freeze. If transactions suddenly dry up because mortgages vanish, it's a sign of systemic credit stress. Property markets are huge. When they stall, it signals deep problems. If you see 3 or more of these warning signs happening at the same time, that's when you need to seriously consider taking action. Not panicking, being prepared. Here's the typical sequence. Warning signs appear, markets get nervous, selling pressure builds. Authorities try to calm things. Sometimes it works, sometimes it doesn't, and panic accelerates. The window between warning signs and full-blown panic is short. Days or weeks, not months. You need to be watching closely and ready when multiple indicators flash red at once. Now, let's go through the playbook for protecting yourself if warning signs start showing. Strategy 1. Currency diversification. Don't keep all your savings in pounds. Open multi-currency accounts. Hold dollars, euros, Swiss francs. Many banks make this easy now. If sterling crashes, having 20 to 30% of liquid savings in other currencies gives real protection. You can also gain exposure through investments, global equity funds, and international stocks. When you hold assets priced in foreign currencies, a falling pound actually increases their value in sterling terms. Strategy 2. Reduce UK bond exposure. If you own gilts directly or bond funds heavy in UK debt, consider trimming exposure if warning signs appear. In a crisis, bond prices can plunge. Premium bonds are backed by the Treasury, so they're relatively safe in most scenarios, but understand what you're holding. You don't want to be caught off guard when panic hits. Strategy 3. Physical assets. In a currency crisis, physical assets often hold value better than financial ones. Property is less liquid, but owning real assets protects you more than renting. Other physical assets, a reliable car, durable goods, or even sensible stockpiles of non-perishables, can help manage potential disruptions. Not extreme prepping, just practical steps to protect your household and maintain some value if the currency takes a hit. Strategy 4. Minimize variable rate debt. If a crisis hits and rates spike to defend the currency, variable rate debt can become painfully expensive very quickly. Consider fixing rates on significant debt or paying down what you can. Fixed-rate mortgages at reasonable levels are generally fine. Actually, inflation helps fixed-rate borrowers by reducing the real burden, but variable rate debt in a crisis is dangerous. Strategy 5. Maintain maximum liquidity. Cash is everything in a crisis. It gives you options, even if the currency loses value. You can cover emergencies, take advantage of opportunities, and avoid selling assets at fire sale prices. Increase your emergency fund from 3 months to 6 months of expenses if you're genuinely concerned. Yes, cash loses value to inflation, but being illiquid in a crisis is far worse. Strategy 6. Diversify income internationally. If your job or income depends entirely on the UK, you're vulnerable. Wherever possible, create income streams that aren't tied to the domestic economy. Remote work for international companies, clients overseas, or export-focused self-employment. It's not possible for everyone, but for those who can, this offers huge protection. Strategy 7. Build geographic optionality. If relocating is possible, start preparing. Develop portable skills, international networks, and understand visa requirements. Get documents in order. You might never need to use this option, but having it available is valuable insurance. If the UK faces a prolonged crisis, opportunities at home could be limited for years. Being able to move gives real security. Strategy 8. Rational preparation, not panic. This is key. Don't make extreme moves out of fear. Don't liquidate everything or stash cash under a mattress. That's counterproductive. But don't ignore real risks either. The vulnerabilities are real, and the warning signs are worth watching. Taking measured, practical precautions is smart. The goal is to position yourself so you're protected if a crisis hits, but not harmed if it doesn't. That's balanced preparation. Now, the obvious question. What's the actual probability of a financial crisis over the next few years? The honest answer: nobody knows. Anyone claiming certainty is either lying or deluded. Financial crises are inherently unpredictable. If everyone could see them coming, they'd be prevented. We can't predict exactly if or when a crisis will hit, but we can assess risk, and right now, the risk is elevated. The fundamentals are weak. High debt, a large deficit, sluggish growth, and a vulnerable currency. Recent history proves the UK is fragile. Remember the trust crisis? Markets panicked and forced dramatic policy changes in a matter of days. On top of that, the global environment is unstable, with geopolitical tensions and potential contagion. If I had to put a number on it, this is an educated assessment, not a certainty. There's maybe a 25 to 35% chance of a financial crisis in the UK over the next 3 to 5 years. Not total collapse necessarily, but a crisis severe enough to require emergency interventions, force dramatic policy shifts, cause meaningful economic damage, and reduce living standards. That's 5 to 7 times higher than the normal baseline risk of about 5%. The trajectory matters. Are things stabilizing or deteriorating? Right now, fundamentals are worsening. Debt is rising, the deficit persists, growth is weak. That means risk is increasing over time. So while we can't pinpoint a date, the UK is closer to a financial crisis than at any point since the Truss episode, and possibly closer than the 1970s. Ignoring this would be unwise. So how close is the UK to a financial crisis? Close enough to warrant attention. Close enough that the warning signs are worth watching. Close enough that preparing is rational, not paranoid. The vulnerabilities are real: 100% debt to GDP, £100 billion annual deficit, £120 billion in interest payments, £600 billion of maturing debt at higher rates, a weak currency, and limited central bank ammunition. Watch for the warning signs. Bond yields sustained above 5%, weak bond auctions, sterling breaking key levels, widening credit default swaps, emergency central bank action, accelerating capital outflows, derivative market stress, property market freeze. And protect yourself with sensible strategies. Diversify currency, reduce UK bond exposure, hold physical assets, minimize variable rate debt, maintain liquidity, develop international income, and build geographic optionality. Stay rational. Stay alert. Is crisis certain? No. Is it probable enough that preparation makes sense? Absolutely. The time to act is before panic becomes obvious to everyone. Once it starts, it's too late to protect yourself effectively. The UK is closer to financial crisis than most people realize. The conditions are present. The vulnerabilities are real. The only question is whether a trigger appears that turns vulnerability into panic. Now you know what to watch, and how to protect yourself if it happens. Stay alert. Stay rational. Stay prepared.